Thanks for coming. Thanks to the people that are on the Zoom meeting for attending. We are going to have some updates about the crop insurance program for the coming year. We're also going to talk about some new private products that we have available in case you want to add extra coverage. You know, prices are high this year when you look at multi-peril, so your revenues are going to be higher, but your premium costs are also going to be a little bit higher, but you have more coverage, so keep that in mind. Given the way that the prices are higher, it might be advantageous if you want to buy some extra coverage through private products or through a couple government subsidized programs called ECO and SCO. You can buy extra coverage through those also, and just to make sure that you protect price. So it's a thought. There's a lot of different thought processes that we'll go through here in the next couple months, I'm sure, before we decide on the exact levels that you want to choose. Some other people out in where it's drier, you know, right now, we'll go through some weather maps here later, but right now there's quite a bit of dry conditions over in North Dakota where it's very concerning for producers. And so they're going to be looking at different opportunities to make sure that they're locking in higher coverage levels, and these private products will be a way for them to do that. So we'll go through that. But I think everybody here is familiar what we do at Northern Ag. We do the crop insurance and the commodity marketing to bring you a total risk management package. So on the crop insurance side of things, we have Armtech here with us today. We've got Brian McIntyre in the back. He's the marketing rep for our area, extremely knowledgeable. He's been on pretty much every part of crop insurance and the delivery of it in his history with the crop insurance program. So it's been we're very lucky to have him as a resource. And we also work with Farmers Mutual Hail as well. We work a lot with them on the hail side of things. And then on the marketing side, we have Midwest Market Solutions. Northern Ag is a branch office of Midwest Market Solutions. So on the marketing side and the analyzing the markets and getting our information, we are just one branch office of Midwest Market Solutions, and I believe they have 11 other branch offices across the Midwest. So that in and of itself gives us a lot of additional information. We know what's going on in our neck of the woods. We read the information that we get from other major market analysts and other news sources, but it's nice to know what the farmers are actually saying, and they have clients all over the Midwest. So it's nice to be able to get hands-on information from their neck of the woods also throughout growing seasons. RJ O'Brien is who we clear through. They are a clearing firm based out of Chicago. They've been around for many years, very well known in the industry. So we do hedge accounts and spec accounts also if you're interested in doing any kind of trading. First, we're going to start off with some multi-peril updates. Here's a screen that we have to put up for the disclaimer. So everything we talk about today is not completely conclusive. There's other details, of course, to the crop insurance programs that we will not be discussing, just for simplicity and time's sake. First, I'll start off with some introductions, I guess, of the Northern Ag people. We've got Kyle Thingvold over here. He's going to talk next, but he works out of the Roseau office. He's a crop insurance agent and a market analyst in training. And then Hannah Torkelson, she's also a crop insurance agent and a market analyst in training. And then over here, we've got Lindsay Osland. She works out of the Roseau office, usually one day a week, primarily Wednesdays, and then out of her Grigla office here the rest of the week. And then, and she's a crop insurance agent. And then we've got Jenny Tillett. She works out of the Thief River office and keeps the whole show organized. So she does a lot of the back office work, so we appreciate that. So with that, we'll start off with Kyle. The quality loss option that he's going to talk about is something that's brand new for this year. So it's something that will likely interest quite a few of you in the room because of some of the recent situations we've been in. So I'll hand that to you. We haven't ever used this much technology, I don't think.
All right, good morning. Thanks for showing up today on this cold day. Yeah, like Jody said, I'm going to be speaking about a few multi-peril items here, and I know most of you probably came for her marketing talk, so I'm not going to bore you too much on logistics of this, kind of highlight some of the things going on with it, and I'll be talking about this, a little bit about prevent and plant, and obviously production reporting, which is exciting for you guys, I'd imagine, and a little bit about hemp at the end. So with quality loss option, this is a new crop insurance option that is put out by the RMA, and it is an option that producers can elect, just like you would do yield exclusion and so forth like that. I'll touch a little bit on what the benefits of electing this on your crop insurance policy will do for you. So quality loss, in a nutshell, what it does, it actually lets you replace your post-quality production with your pre-quality total production. So I'll go through an example here. If you think back to a couple years ago when we had the falling numbers issue with wheat and how it would affect your APH over the 10-year period you have on your APH report. So this is an option that must be elected on sales closing date. When you choose your multi-peril coverage, it's made on a county and crop basis. And if you elect the APH database and crop year by production reporting, it has to be reported by the production reporting date of April 29th. These are the crops that are available to have the quality loss option, and basically it is an option that's covered, that has coverage on most of our crops in this region. Forage is not eligible. Like I said before, you can choose it on APH database or eligible crop year on the number of years that the actual yields can be replaced. Looks like we had a little internet twerk there. If you can hear me, can you still hear me on the Zoom? Just said the internet was unstable, so. Quality loss option is continuous, and so basically until you choose that you're going to cancel, it's going to carry over year to year. We have a report that and basically we plug in the quality loss option and it will enter your pre-quality production, and it will adjust your overall yield using the pre-quality production. So in this example, you can see in 2019, their total production was, this is post-quality production, was 11,718, and their pre-quality production was 23,436. So with utilizing the quality loss option, it brought their total yield up to 72 from 38. So you can see how that can affect your overall APH value over time, especially if you go back and look in other years. The one thing about the quality loss is if you do go back and elect this for previous years, you do have to have a notice of loss or a claim on that. And irregardless if that claim was paid or not, you are still qualified to use that pre-quality production to help with your APH. So in this example here, this is an example from 2019, as I mentioned before, with the issue with falling numbers. So this was the APH database in 2019. Production was 4,500, and the yield was 45 bushels per acre. After using the APH database with the quality loss option, your pre-quality production was 9,000, and your pre-quality yield jumped up to 90. on that. So this is something that we at Northern Ag, we can take and go and take a look at your past production, and if you did meet the qualifications to use it, it can actually your APH value significantly on the quality loss side of things. Anybody have any questions on quality loss? Next, I'm going to talk a little bit about prevent plant. Hopefully this year it isn't a significant thing like prior year with all the moisture. Obviously, we know that can change in any given time. So with prevent plant, there continues to be a buy-up option of only 5%. So this is off your base level. You can add 5% coverage on that. In the past, it was 10%, dropped down to 5% last year, I believe. Not all land that you take on brand new is eligible for prevent plant. This is just an example of your base level, and you just add 5% to whatever your base level is on that crop, and that will give you the added coverage should you choose that buy-up option. With prevent plant, I'm sure many of you know you have to file a claim within 72 hours of the final plant date or within 72 hours of the extended plant date if you choose that you're not going to attempt to plant the crop. All PP acres, should you have them, need to be listed on the acreage report. And when we go through acreage reporting, we're pretty diligent about asking, you know, we're pretty aware of when you do have the plant acres, and we'll get that taken care of for you. Just a few other highlights is that you can't add PP after the initial acreage report has been filed, and it cannot be revised after the initial report has been filed, except in certain situations, which you obviously don't know by memory, but we have a pretty good idea of when that is necessary. Any questions on PP? All right, favorite thing, everybody, is reporting production and all the rules that go in the paperwork involved with that. I know it's an exciting topic, but it is something that we do stress here at Northern Ag because it can have a pretty good effect on a negative effect on your APH over the long run if you don't have the proper documentation. So I'll just run through this quick, and if you have any questions, let us know. But as most of you know, the written verifiable records is key should you ever get audited. And there's many reasons where auditing could occur. I mean, it can be random, like large claims, discretionary. Just there's many options that can bring up an audit of your claims and your production. So a 5% tolerance is all that is allowed when you're reporting your production. There are variables that can change this and where you won't get pegged with assigned APH values. But if you are above that 5% tolerance level, and you do not have the supporting documentation after the audit is through, you will end up receiving an assigned yield for your overall APH for that specific crop or unit. Or it's all units across the board if you are off. If you're underreported, they'll update with the actual correct figures that you have. So on this example here, the actual yield reported was 38 of soybeans. The actual determined yield was 34. The difference in the actual reported yield was 11.76%. So that doesn't take much to actually get above level. So as I was saying, assigned yields, if the insured fails to maintain or provide acceptable records, all units with planted acres for that crop year will receive an assigned yield. An assigned yield is 75% of the prior year's approved yield. Unless the actual determined yield is less than the assigned yield, then the actual yield must be used. So there is some ways you can get around it. If you actually did use an acceptable method of reporting, it's determined that it was an acceptable record at the time, and you won't be subject to the yield tolerance rules or assigned yield procedures. So for this, an example would be your production was originally off a bin measurement, and but at the time of the settlement sheet, but the settlement sheet was used at the time of the review. So you may be off 5% because the bin measurement is actually an acceptable method, but the more accurate was the settlement sheet following the review. Does that all make sense to you? I'm sure most of you have got your methods down. Supporting documentation can be elevator assembly sheet, bin measurements, load records, logs off your combine monitors, your grain carts. Those are all acceptable. And with today's technology, everybody has their notebook in their tractor or combine, or they just pull off the monitor. All that is acceptable as long as it matches. Make sure you're keeping each unit or field separate. If you're mixing or commingling crops in bins, you're going to need to mark your bins on separate units and fields. Use your load logs for loads off each individual field. And then if you are using bins that have crop from prior years, you must also mark your bins, have an adjuster come and mark your bins in that situation. And along with production records, that also includes complete records of your planting, replanting, inputs, production, and harvesting. And everything must be kept for a 3-year time period following the current crop year. Any questions on production reporting? The exciting topic. All right, I'm going to talk just briefly on hemp. Hemp has become more popular in the area over the past 2-3 years. There's getting to be more processors, and people are looking more into the possibly raising hemp. With hemp, there tends to be a lot of state and federal regulations, obviously, with THC values, and so if you are ever interested in raising hemp, there's some avenues you have to follow. You have to get background check and licensure, and just takes a little bit more time. You just can't go out and grow hemp. You need for hemp to be insurable, you have to have previous production evidence, FSA acreage certification, and THC testing records. And as I said, you do have to have a contract with a processor. With hemp, there is no replant coverage, no preventive plant or written agreement at this time. And should the hemp that you do grow be unsaleable or destroyed due to the high levels of TH, where their tolerance is a 0.3% threshold, the damage due to it's considered a damage done due to unsurable causes, and you will not be paid in that loss. So it tends to be risky. I know Jody has, their family is growing it, and I'm sure they can fill you in on their feelings of that. So if it's something that you'd be considering. And with hemp, there is also rotation restrictions that you have to abide by should you plant it. And these crops right here cannot be in the rotation. So it affects your soybeans, canola, sunflowers, anything that you grow in this area. So that's hemp in a nutshell. And if you have any questions regarding any of the stuff I spoke on, Brian McIntyre from ArmTech is going to talk about a couple of his products. And thank you for coming today, and we'll see you throughout the year. Hope it's a good season for you guys. This is for...
Would you use to switch slides? Just the mouse? Okay. Good morning, everybody. If I don't trip and fall and get tangled up in all of this, then sorry about that. Yeah, with all the cords, I'm going to trip and fall because I'm pretty clumsy as it is. So if I don't, it'll be a miracle here. Thanks for having me up today. Good day to be here. I know everybody said it's cold. It's cold for me, but I know it's been a nice winter, and so it may not be very brutal. We can handle 1 or 2 days of this. This is no problem, I guess. But so what I'm going to go through, I'll be real brief on this today. Starting out with band coverage. Band is just a product that, okay, it's just a way. It's a private product. It's not through the RMA or anything like that. It's just a way to maybe supplement your multi-peril policy. Okay, so if you think that you want a little more coverage, you want a little more price support or something like that out of what your multi-peril offers, it's a possibility to look at. Okay, so I'll kind of walk you through that a little bit. It's not a new product. We've had it for a couple of years. We don't see a lot of it used here, but we see a lot of interest and people kind of look at it. We sell a lot of this in southern Minnesota, Iowa, the main, Iowa, Illinois, those kind of states there where a lot of corn and beans and things like that. Up in our, neck of the woods up here, and then North Dakota, where we have a lot more variety, not just corn and beans. And, we're a little different climate here. Our base rates are a little higher, so these kind of tend to be a little more spendy than they are in some other areas. But it's still worth looking at, and it's still not a bad rate if you're looking for something like that. So we just kind of want to walk you through how some of these things look and kind of walk through that. So what is band? Band coverage protects against shallow losses. And so you can see in the example here, the 85% in green, that's supposed to represent your multi-peril policy. Okay, so I know 85% level is probably not what's common or realistic up here, but we sell a lot of that in some other areas. We see a lot of 85% level coverage. Okay, so if it's not what you see here, that's okay. It's just for representation here to just looking at here. But that's your multi-peril. And what you can do is you can say, okay, well, it's covering 85% of my APH. How do I get more? How do I get more coverage of that? I need more bushels protected. What you can do with band here, we allow you to go up to 95% of your APH with band. Okay, you can go up to 90, you can go up to 95, you can go up to 93. Okay, you have to have at least 5%, but after that, you can do it in 1% increments. Okay, so it's a way to basically get more protection out of what your APH is offering, or from what multi-peril will offer. Now you can see here that it doubles up, so it goes from 95 down to 50. You can do that if you want to, or you can have it just go from 95 to 85 and have no overlap, okay? You can customize it however you want to do it, okay? But it does allow for that. And it does allow for this kind of example here for corn and soybeans, okay? Where we allow you to go over your multi-peril level. For everything else, we allow you to go up to your multi-peril level, and we can kind of do a little, what we call like a sideband or whatever, to give you a little more price support with that. Okay, that's basically how that works. The crops here that it says wheat, corn, soybeans, sugar beets, we have a lot more crops than just that. These are the most common that we see here. Okay. The bottom bullet point there, that's just a basic rule for, you know, from the Department of Insurance. Okay, you're not supposed to be able to insure anything more than the value of the crop is worth anyway. Okay, so that's just what that's there for. And you have to be careful whenever you do something like this. If you're going to go up to 95 and then double up that far down, then we have to start looking at things. Maybe we want to factor down your band to not give you 100% of that price for that much of a range, because then we are basically over-insuring the value of what that crop is worth. Okay, so that's why that bullet point is there, just to talk about that. And it's something that we kind of have to look at. Coverage levels, pretty standard there. Basically anything that's available that you're buying for your multi-peril is available for band. Okay. Kind of talked about that before. These are just some examples real quick that we can kind of look at just to kind of show you how this would work. This is a wheat example. You can see the top line there, the approved yield. So we're looking at a 50 bushel APH. Okay. 1,000 acres, 75% loss trigger. That's on the multi-peril and the band side of things. And then a $6 price. Okay. So if you look at that, you take the 50 bushel APH times 1,000 acres times a $6 price. We're looking at $300,000 so like a crop value out there. Okay. Your multi-peril's on 75% coverage, so you take 75% of that, and your multi-peril is basically covering $225,000. Okay, of that $300,000 value of all the crop that you have out there on 1,000 acres. Okay, so if you only do a 10% band, like in this example here is saying, then 10% of that 300,000, you're going to get $30,000 worth of band coverage in addition to your multi-peril. So you add them together and you're covering $255,000, okay, worth of the crop. So you're basically shrinking down your deductible, or basically putting a little more coverage out there than what your multi-peril policy is actually providing. So here's what it looks like. Maybe I'm a visual person. If you don't want to just see the numbers, you want to see how it looks like. Well, I just did something here. Okay, so on the far left, the crop value, that's the 1,000 acres times $6 times 50 bushel an acre, that's 300,000. Okay, you can see there in the middle, or coming to the right, the orange there inside the middle of that big blue square. The orange is the 75% peril. That's what your multi-peril is actually covering on your farm. Okay, when you're looking at this wheat example. So that's what that looks like. The 10% band that you're going to add on there for wheat, you can see what that 10% is. It goes from 75% down to 65. That's where your band coverage is. So now that you know what your coverages are, at harvest time, if you harvest 42,500 bushel, that's on 1,000 acres, that's 42.5 bushel yield, right, on average. If that's what it is, that does exceed your guarantee, so there's no claim there. But that's a pretty decent yield, right, as far as this example goes. If you come to the little farther right, 33,750 bushels maybe instead, you can see now you're in a claim situation. How does that claim work on your 1,000 acres? You can see here that it's still not quite all your band coverage that's there, but you're looking at about a $22,500 loss on your multi-peril side and a $22,500 loss on your band side. Okay, remember you got $30,000 worth of band coverage, and you got close to getting all the liability, but not quite. But if you have a little deeper loss, you know, your bushels are only running about 25 bushels an acre or whatever, so not a good year as far as that goes. Your multi-peril is going to pay $75,000, and you've exhausted all your $30,000 of band. You know, so it does basically supplement that payment just a little bit. Okay, so that's one way to look at it. This example was basically a 10% band. You can go from 75 all the way down to 0, just like your multi-peril, and double up that way. And then we basically have to factor down the price so we don't overinsure that crop. You could do it that way, or you could have from 75 down to 50. You could have a little deeper band instead of the 10%, or you can do a 5% band. You can customize this a lot of different ways. It's basically just It's just an add-on to maybe supplement your multi-peril is all it is, okay? Hopefully that makes sense a little bit. Another example, basically the same thing, but instead of a 10% band, this is a 5%. So you can see that basically you're going to have half your liability. So whenever you look at all the numbers, same scenarios basically all the way across, you're looking at basically half the numbers on the band because you're only taking 5% instead of 10%. Okay, but that's visually kind of how it looks and how it works. Any questions on that? Okay, so that was on the private side. That's an Armtec product that we have. Every company has a private product that does something. Band is so flexible and so, I mean, you can customize it different ways. We can basically replicate anybody's product that's out there. You know, so you hear of, I have Ramp, or I have ICE, or I have PriceFlex, or I have whatever from all of these other companies. Band can do it all. I mean, you can manipulate different things and scenarios, and you can replicate anybody's product out there. So it's pretty nice how Band works. Okay. I must keep bumping the wheel here. I keep going backwards. Sorry about that, everybody on the computer. A couple of things here on the RMA side that does carry some subsidy. It kind of does a lot of the same things that Band does do as far as supplementing your multi-peril policy. The thing about this though is there is a subsidy that's involved, so premiums can be a little cheaper. The downside is they are countywide programs though. They're not individual policy related coverage like Band would be for your policy, okay? If you have a loss, you get paid the loss. The countywide stuff like SCO and ECO is, if you have a bad year, but the county does good, you pay the premium, but you still don't collect a claim, okay? It's kind of give and take, but they are rated that way and they're cheaper. So it's something to look at and something to consider. It's not a downside. It's just the way the policy is. It can work good for some people. It can work bad. It's just, it depends on the year and depends on how things work. Okay. Yep. As far as unit structure on Band, it can follow your multi-peril policy or it doesn't have to. So for example, if you have wheat or soybeans or whatever, and you have your multi-peril in an enterprise unit, you can choose your Band unit structure as an enterprise to follow your multi-peril, or you can choose to insure it at an optional or a basic unit level as well. It doesn't have to follow your multi-peril, okay? Or you can do optional units on your multi-peril and an enterprise on your Band, okay? You can basically pick and choose how you want to do it, okay? Very, very flexible in how you want to set it up and how you want to have it covered, have it cover your crop. Make sense? Oh, yes.
You're really stupid, but I still don't understand why you can double up under 75. What is the sense of that? I can see where the concept of getting over the 75, but if you're only allowed to get 75 in your MPI, your crop insurance is giving you 75. If you got a 10% ban under 75,
What's,
are you collecting anything on that?
so the question for people maybe at home on the Zoom, if there's, I don't know if they're able to hear the question. The question was, why do you go, what's the advantage of Band if you're not increasing your trigger to go over your 75 level where your multi-peril is, right? What's the advantage of that? The advantage basically is it becomes a price. It becomes a, basically you get more more value out of your price selection. So in this example here, you're getting $6 for your, that's your price selection on multi-peril. We're using $6 too on your Band. So now you're basically, if you, as soon as you trigger a claim, you're getting $12 a bushel. That's what it does. Does that make sense?
You're double collecting on it.
You're only for a portion. Only for a portion like this right here for that 5%. So you're going to collect, you're basically getting $12 a bushel for everything that's basically from 75% down here. And then after that, you've already collected your Band coverage. So then it's going to be $6 for the rest of that there. It's a price support. It's just a little, so you could, what you could do, a more realistic example would be if you did a 5% Band or 10%, or not, excuse me, if you did Band and have it double up all the way down. That way, if you trigger a multi-peril claim at any level, you're going to get a percent of that price selection of that $6 additional. So if you did like a 75% all the way to zero, and then you factor your price instead of $6, we can't give you $6 all the way down to zero because that's truly doubling up everything. So we're going to factor that $6 to probably 65% of that and give you whatever that would be. So probably say $2. So if you trigger a claim, we're going to give you the $6 on multi-peril and an additional $2 a bushel for your loss on band all the way down. So essentially you're insuring for $8. So if you have a contract, for example, that's higher than what the price selection is and you want a little more coverage out of that, you could do it this way. I don't know if that answers the question, but does that make sense?
Yeah, I think it does. The one other thing to think about, you might, if you're looking at it from an optional standpoint, if you take enterprise units on your multi-peril, but there's a couple problem fields that you say you're gonna plant P2 and you want a little bit of extra coverage. This product is taken out by crop, and then each unit that you actually plant in has to have the band on it, so you don't pick and choose the exact unit. So like if you have two problem fields that you want it on, you actually have to take it on all the crop acres that you plant. So that is clear, otherwise it would be a program.
Yeah, it's all acres of the crop. Yeah, we can't pick and choose where we want it, like a hail policy or something like that, you know. That answer the question, or maybe help a little bit? I had the same question when I first looked at it. To me, I thought, well, that doesn't make sense. If you want to supplement your coverage, you want a higher trigger. You want to be able to reduce that coverage, you know, from 75% to 100%. You want to take that 25% gap and lessen that, you know, lessen, or don't make it the same. I mean, let's lower that. But if you look at it from the pricing standpoint, it basically, we used to have a product called APCO and RevCo. Remember those, Jody? Basically, this is the same thing. This is what RevCo would be. It's a price support, you know. So
Another thing to think about, Brian's going to talk about a couple other programs that, like you said, are subsidized by the federal government. And you truly could take your multi-peril policy, add band to it, which is a private product that we're discussing, and then also take SCO and ECO so that you have a higher protection on top. And those are area-based, meaning if your county triggers a loss, then you would be able to receive a payment on those programs. But those three additions would really pack on the insurance coverage for the coming year if you were looking for additional coverage.
Yep, I agree. We have a lot of guys that grow sugar beets, and they're looking at, they have a 75% level on their doing SCO, but they're looking at adding ECO, which is, we'll get into that here in a minute, and then having bands supplement the middle there, because they said we can do a county deal on ECO, but we don't want to do the SCO, so we'll look at bands. So that they would be actually having 3 different policies. They'd have an ECO policy, a band policy, and their regular multi-peril to cover up to 95% of that farm. You can get pretty creative in how you want to do all this, and like I say, whatever. There's no right or wrong answer. It's just whatever you want to do. But there's a ton of options now that we have available that we can use. Okay, SCO is not new. It stands for Supplemental Coverage Option. That is not a new program. That's been out there for a few years. And what it is, it's another way to supplement your multi-peril. The ECO is a brand new product that's out there. Basic has a private product. Ours is banned. Everybody else has one that allows you to go up to 90 or 95% coverage. So the government stepped in and said, well, okay, well, if everybody's already doing it, why don't we just come out with our own program? It can be subsidized. People can elect it, add it to the multi-peril policy, and away we go. So that's what we have here, okay? So we'll look at SCO real quick. It is a county level crop insurance option, okay? So just keep that in mind. It's not your necessarily yields and things that we use to calculate a claim. It's a county level policy. So it says the loss is paid when there is a county level loss in the yield or revenue. It's an endorsement to your policy that you already have, okay? And it's subsidized at the 65% rate, okay? It says they must sign up for the PLC on the farm program. So if you are insured or are enrolled in the ARC program, you can't have SCO because they're similar in how they pay out and how they work. And the available crops here that we have for SCO: barley, corn, soybeans, and wheat. Here's an example of what that would look like from 0 to 75% there. If we kind of start at the bottom and kind of work our way up, you can see that's where your multi-peril policy is. So, it goes up to 75% level. In the middle there, the little darker shade of orange, SCO will always, and it can only go up to 86% coverage. I don't know why the magic number of 86, but that's just what it is, okay? So it has to go from 86 and it will come down to wherever your multi-peril level is. In this example, it's 75. So you're covering from 86 to 75% of your APH with this, okay? If you were on a 70% level, it'd have a little more coverage. It would go from 86 down to 70. So SCO would have a little bigger width there, a little bigger band there, okay? And then above 86, there's no coverage there because SCO, it has to stop at 86. So looking at some numbers here, how we calculate some things. In this example here, we have a 55 bushel APH, 650 price. We're looking at about $357 worth of value of the crop. That's on a per acre basis. At 75% of that, we have 268 of this 357 covered under multi-peril. Okay. And where SCO starts to kick in is whenever the average revenue in the county falls below 86% of that expected level. If that happens, a claim is triggered, okay? It doesn't matter if your yields fell 86% below or 86% above, it doesn't matter, it's on a county basis, okay? So like I said before, the trade-off is, if your yields are great, but the county-wide yields don't do so well, you could have a good crop but also the other side of that is true. You could have a bad crop and the county do well and you get no claim on this either, so you never know which one to do, but that's just the way it works. Okay. So I'll mention that not as a negative, but just keep that in mind that it doesn't follow your actual performance on the farm. Okay. And this is where your SCO coverage will be basically 39% or $39 an acre is what your SCO coverage is. It's 11% of that liability. ECO, like I said, was brand new this year. ECO will allow you to go up to 90 or 95%. Okay, it's either 90 or 95. You can't do a 93. It's got to be either 90 or 95. And it basically covers from 86% where SCO basically stopped at, from 86 to either 90 or 86 to 95. Okay, so it's even going a little farther to narrow that gap of your deductible where your coverage will go to. Here's another little illustration of how this works. You have your multi-peril policy here. Next over, where you have the ability to add SCO to it and then stack ECO on top of that. Okay, so it's a way to help shrink down your deductible and add more coverage to what you already have. Okay. It's an endorsement just like your SCO policy is. And again, the 90 or 95% trigger. Here we have the available crops here. So for a brand new product that just rolled out this year from the RMA, it's pretty inclusive to most everything that we see. They didn't just start with corn and soybeans and then give us 4 years to wait for everything else. Okay, so they kind of rolled it out to kind of benefit everybody the first year. Here's an example here. It says you can have ECO and ARC on the same acreage. Okay, I say ARC, ARC, whatever, same thing. It's an FSA thing. You can't have SCO and the ARC program, but you can have ECO because ECO is above that 6% trigger. Okay. The ARC program makes an actual crop revenue if it's less than 86% of the county benchmark. So that's why ECO is outside of that. So here's what that could look like. If you have 75% multi-peril, you can still enroll that farm in the ARC program and do 95% or do 90% of ECO, or you can do the same thing and have 95% ECO. You don't have to have the SCO program if you want to do this. You can have a gap in your coverage. You can have your multi-peril and stack ECO on top of it and have a gap there, or you can fill that gap in with the SCO program. Okay, you can pick and choose how you want to do this. Okay. We'll kind of get into a couple examples here real quick of this. In the example here, 820 acres of soybeans. You have a 35 bushel APH with 1160 price. 75% level of the multi-peril. So if you look at that, add all those numbers or multiply those numbers across, you get $250,000 worth of liability of soybeans on that 820 acres. Okay. If you look at how the ECO coverage is determined, you're at 9% range because ECO is at 95% down to 86. That's basically 9% coverage. Okay. So we're taking that 250,000 divided by the 75% coverage of multi-peril times 9%. Is $30,000 worth of ECO coverage. That's how you determine how much liability you have on the ECO program. Okay, talking about premium rates, I haven't looked at every crop in the area up here, but 30% is probably fairly common or realistic. May get down to 27, 28%, something like that, but 30 is close. So if it's a 30% rate and you have $30,000 worth of protection and it's 44% subsidized, then you can see out of all those numbers, you know, you're looking at about $9,000 worth of premium. So you're left with about $5,000 of producer paid premium. So if you look at $5,000 divided by the 820 acres, you're looking at about $6 an acre, a little over $6 an acre for that kind of coverage there. Okay. Any question? I mean, that's kind of high level, quick example or introduction into what ECO is, but any questions on that? It's a brand new product from RMA this year. It's pretty common. I mean, a lot of questions, a lot of interest in it right now. Nobody's bought it in the area, but there's a lot of people looking. Looks like we got some water running everywhere. I happened to look over there. Oh, okay. Is Lindsay? She's on that? Perfect. Okay. Sorry about that. But anyway, back to ECO. It's like I said, a lot of interest in that. People are looking at it. People are quoting it. If it doesn't work for you. That's fine. We're not here to tell you to take these things. We're just here to tell you that these things are available. Let's look at it. Let's look to see if it's going to help you. See if you want to do something like this. Okay. Jody, anything else? Kyle, Hannah, anybody? Questions? Okay. Thank you, guys. And I didn't trip on a cord, guys.
Oh, okay. Sounds good. Okay, everybody hear me okay? Okay. My name is Hannah Torkelson, and today I will be talking to you all about crop hail insurance. Then we'll be discussing some FSA programs too after we're done with the crop hail part. So as far as the policy types for crop hail, a lot of you are pretty familiar with it. There's full coverage. They also do your classic deductible plans of 10%, 20%, and 30%. And they also have your companion plans. So to talk next about companion policies and essentially who they're for. So your MPCI level is actually going to cover the bottom 50 to 85% of your APH. So anybody who wants to have the top portion of their crop covered, the companion plans are a good policy for you on that aspect. They're available for most crops covered by MPCI and all those who have a buy-up on their MPCI policy as well. So essentially the purpose is to cover on an acre basis. So just some examples here of your payment factors. So say you have an increasing payment factor of 2 on your 50 to 60% MPCI level, that covers the top half of your crop. And then also if you have an increasing payment factor of 3, those plans are going to be more expensive than the payment 2 factors. So essentially to kind of keep those on the more cheaper side of things as far as your premium goes, you would just have to do a little smaller amount of coverage on their smaller dollar amount. So more on the Companion 2 Plus, also known as the Cadillac plan. So a policy in which the insured will receive full coverage on all losses up to and including 10%. Any losses exceeding that 10% will be calculated by deducting the 5%. And then from the adjusted loss and multiplying it by a factor of 2. So for some examples here, you have a $300 per acre coverage line. So say your loss, you trigger a 6% loss, you would take your $300 of your coverage, multiply that by the 6, giving you an $18 payment there. So it's not quite at that 10% level. So as you can see on the following calculation, if you trigger an 18%, you would deduct that 5% there, and that gives you 13, multiply that by 2, it's 26%. So you would take your $300 of coverage, multiply that by 26, giving you a $78 payment. And so the same for the 40% as well. Now when you get to the 55% level here, that's actually where you're going to receive your full coverage payment on there. So you would take your 55% minus your 5, giving you 50, would give you 100%. So essentially with your crop hail insurance, your crop is actually covered when it's in transit. So whether that be in the harvester, on the way to the elevator, warehouse, your crop is covered. So that would be any perils including windstorm, fire and lightning, collision, collapse of bridges, docks, and then it's limited to the amount of crop unable to recover, and includes reasonable expense incurred in the salvage recovery of your crop. So as far as your stored grains go, it would be structurally sound, completely enclosed. So a storage bin, building facility that's either owned or leased. The perils for that would be fire, lightning, and windstorm, accidental explosion and smoke damage. That coverage essentially expires as soon as that crop is marketed or sold, as soon as it essentially leaves your direct care. So it gets delivered to the warehouse, elevator, is when that coverage would expire. So some other insured perils would be vandalism, theft and mischief. So it's $250 per occurrence, and it must be reported to law enforcement. Your standalone crop fire policy, that perils would be fire and lightning for that. It protects the crop in the field for a period of 60 days following the effective date, so that coverage is before and during harvest. Your grain fire will cover all fire losses beyond what your crop hail policy covers, and it's up to the coverage limit of your grain fire policy. So the cost for that would be 25 cents per $100 of coverage. The fire department charge for that would be, policy would pay up to $750 per occurrence, and it wouldn't exceed the $1,500. Are there any questions about crop hail at all? Okay, so then with that, we're going to move on to some FSA programs. So first we'll talk about ARC PLC. We did a lot of calculating and running numbers for a lot of our producers last year. So essentially with your elections for 2021, I'll just kind of cover, some of the definitions of PLC, ARC, and kind of go into what we think for recommended payouts this year. So PLC is your price loss coverage. So essentially you use your effective reference price and the PLC yield established on the farm. So a lot of you, some of you might be familiar with your PLC yield update that was done our 30th of 2020. So essentially if you updated your PLC yields, you'll want to get new 156 EZ forms from the FSA office to actually calculate your new ARC PLC payments for that. Your ARC County agriculture risk coverage, you use your marketing year average price plus your county yield to calculate. And then your ARC individual, you use your marketing year average price plus the producer's yield from the farm. So essentially some of the differences between the three here. So the payments are determined by base acres for PLC and ARC County, whereas ARC individual, they're actually determined by the planted acres on the farm. The payments for the ARC individual, they're made on 65% of the total base acres. With PLC and ARC County, they're made on 85% of the base acres. With ARC individual, you do have to report your production to FSA. With PLC and ARC County, you do not have to report your production. And essentially for your ARC individual election, pick that option. You have an entire election for all your commodities on all your farm numbers. Whereas with PLC, ARC County, say you have a farm number 1, 2, 3, 4. You have wheat, soybeans, and corn on there. Say you happen to find that PLC is going to pay better on the wheat and soybeans and corn, you're thinking more ARC County, you can actually do that per farm number by commodity basis. So these are some projected payments for PLC. So I'll kind of go over this with you. So essentially they're triggered when you're marketing your average price is less than your reference price. So we'll kind of see here the wheat, barley, sunflowers, canola, and flaxseed. As you can see, those projected marketing year average prices are lesser than their reference price at the moment. So you would take that into consideration here. Now the USDA has projected these marketing year average prices for 2021-22. But as we know, the marketing year hasn't really begun for that. So what we have projected for prices are these on the following left here. So what we're kind of seeing as far as PLC payments, if they are triggered, they're going to be lesser. We're not really seeing a whole lot of triggering just because the prices are higher at the moment. However, as you know, markets can change. So for your ARC County details, the yields are going to be based on county data and not your individual farm data. The payments will be triggered when the actual county crop revenue is less than the county guarantee. So say you have an FSN with land in more than one county, you use that physical location for the revenue calculation, and you would take it down to the tract level, then it's weighted by a commodity base on each physical located tract, summarized to the farm level. It gives you benchmark revenue guarantee, actual year payment, and payment rate for the entire farm number. So these are your 2021 projected ARC County payments. So essentially when the revenue guarantee is higher than the expected revenue is when you would retrigger a payment for ARC County. So as you can see, wheat, barley, oats, corn, soybeans, sunflowers, there possibly wouldn't be a payment for that as of what they have calculated here. Canola, there could be a potential payment just because that revenue guarantee is more than the expected revenue at the moment. But like we said, those can all change. Just some important date reminders. So for your 2020 enrollment that you guys did, you will be receiving that payment in 2021 in October. So for the payments for 2021, you will receive that in 2022. So it's always a year behind on there. The deadline for this is March 15th. And if you guys need help running numbers, we definitely can help you with that. Otherwise, what we're kind of seeing as far as your elections go, it'll be pretty self-explanatory as far as the pricing. So for each year under the 2018 Farm Bill, for 2021 to 2023, you can actually change your elections annually on there. So if a producer, if you farm the ground in 2020, you don't have to change your election. It just rolls over from your previous election of what you would have picked. Just some limitations, ARC PLC 5,000 for sole proprietor and corporations, and then partnership it's 125,000 per partner. So these are kind of our recommendations is what we have for 2021. So if you have a good yield on wheat, barley, and sunflowers, we say lean more towards PLC. If you on oats and corn and soybeans, ARC County as of right now would be triggering a payment possibly, and then canola would be PLC. But we're kind of seeing if payments are triggered, they are going to be on the lesser side of things. Are there any questions about ARC PLC? Okay, so we'll move on to some more FSA programs. So this is the Quality Loss Assistant, or QLA. So essentially this is assistance for producers who had eligible crops that suffered quality loss due to excessive moisture, flooding, snowstorms during the 2018-2019 crop years. So your applications for that are accepted January 6th through March 5th of this year. These crops will be covered by your MPCI and NAP policies, are considered the eligible crops for this quality loss assistant. Your unharvested crops and grazed crops are not eligible. And if you want to go on to this program, you just call your local FSA and say you want to be on their register list is what they call it for the quality loss. So in addition to your application materials, you do have to submit data documentation showing the quality loss and the quantity of the affected production. So I'll just kind of go over some of the documentation that would be acceptable to use for them. So sales receipts, settlement sheets, truck or warehouse scale tickets, written sales contracts, records that actually represent the specific quality loss information. So falling numbers, test weight, protein, price before discount, or forage test for nutritional value. So for your quality loss assistant, some more verifiable documentation for grain crops that were sold may come from any time between harvest and the sale of the affected production, unless the FSA County Committee determines the record is not representative of the condition within 30 days of harvest. For all crops, verifiable documentation must come from tests or analyses completed within 30 days of harvest unless the FSA County Committee determines that the record is representative of the condition of the affected production at the time of harvest. So for forage crops, you do have to submit verifiable documentation showing the nutritional value for the affected production, and you must also submit verifiable documentation of historical tests that have been done for the past 3 crop years. So for the FSA program, some of you are probably familiar. Oh, sorry.
A lot of wording for that one.
Yeah.
But what it really means is, originally when that program came out, they said if you were paid on your crop insurance for quality loss, that you would not be able to be eligible for this program. Then the FSA office came out, or the FSA, what they're saying now is that they don't care what RMA did, they're still gonna pay. So, long story short, if you had any kind of quality losses that you would qualify for this program, whether you've been paid a claim or not from RMA, from your multi-peril insurance policy, it would be a good idea for you to call the FSA office and to put on their registered list, just in case. Because you don't want to be passed by if there's any funds that might be available for this program you can qualify for.
Is there any questions about the quality loss at all? Okay, so we'll move on to the CFAP. So a lot of you are probably familiar with the CFAP 2.0. So this is kind of an additional to that. This is the CFAP 2.1. So if you had reported in your 2019 tax year sales for edible beans or dry peas under the CFAP 2, you can now actually revise that and add those commodities in there. So essentially you would just call FSA with your payment amount so they can revise that application. And the estimated payment will be approximately 10% of your MPCI indemnity or your WIP plus payment. So essentially they would revise that application and include any crop insurance or WIP plus payments for those commodities. And for swine producers, they would receive an extra $17 per head on there based off their CFAP 1 numbers, and it'll just be a supplemental automatic payment for them. So this is a new program. We haven't heard anything official on it quite yet. So this is just some information that we have gotten, but it's nothing is actually set in stone. This is a CFAP 3.0. So they're kind of hoping that this will be a supplemental payment. So producers wouldn't have to go in and actually sign up. It would just be supplemental and revised off your CFAP 2.0. We're not sure if you would have to go in and sign up, but we'll keep you posted on that as we know. So your potential payment for this would be $20 per acre as listed on your CFAP 2.0 application. So that would include wheat, barley, corn, soybeans, sunflowers, alfalfa, canola, sugar beets. And the potential time frame for this would be March or the beginning of April. Are there any questions about the CFAP? Okay, and at this time, I'll turn it over to Jody. I turned that off.
Forget how to clip it every time.
Okay, so we're going to go through some of the main information that's affecting the grain markets these days. Obviously, the U.S.-China trade, increase in the trade has been a huge effect on the grain markets for really, big time in the soybean markets and then also in the corn market now. And then in the soybeans and in the corn, but right now soybeans are front and center. They're looking at the South American weather conditions. They've definitely seen an increase in precipitation in some of the driest areas, which has helped to lessen the yield drag. But then they're also seeing extreme wet conditions in areas that they're not wanting it. So they're looking at port conditions and just growing season concerns. They're looking at possible, well, they are actually reporting an increase in rust conditions and things like that in some of the areas. And then, of course, looking at South America with their reduced prospects for crop size, crop coming to port, we're having an increase in our exports, which is really the main reason why the markets are the way that they are. And then the world wheat supplies are also getting a little bit stressed in some of the more important growing regions of the world. And so that's helping the US cash price as well. So first, when I start off looking at different stages throughout the year, what we think might end up affecting the prices during our growing season, I like to look at the US Drought Monitor. This US Drought Monitor is from back in January of 2018. So a few years ago on that one, there was some dryness concerns, not too bad. And then as we went through 2019 throughout the winter and 2020 throughout the winter, there wasn't as much dryness concerns. But now we put up the 2021, see that there's quite a bit of dry areas throughout the western areas, and actually Minnesota is starting to show some dry concerns as well. In the crude oil market, we've seen prices continually rise since the beginning of 2020. And right now we're trading, well, this is as a couple days ago, we're trading around $52 a barrel. And the first area of resistance that we're seeing above this area would be $65 mark, and then above that would be $75 a barrel. And there really isn't any kind of fundamental news that would make us believe that the crude oil prices would go lower. So I guess if you're able to lock in some fuel prices, that probably would be a good idea. As far as the US dollar index is concerned, that's something that we like to look at as well. It gives us an indication of how our US grains are doing on the world export market. So the weaker the US dollar, the better it is for our ag commodities. And the US dollar has also been declining since the beginning of 2020. And it looks like it's on a projected path to be able to continue to do that when you look at the different chart indicators. So right now we're in the low 90 area for support. Nearby support would be 88.50, and then we would drop down to 85. And you can see this is a weekly continuous chart. So it goes all the way back to 2014 on the left. So you know, we're hitting long-term support at that 88.50 here soon, and it does look like we're going to, you know, kind of free fall down into the 85 area as long as things stay the same with monetary policy. First, we're going to talk a little bit about wheat. This is hard to see from your guys' standpoint, I see. Okay, so I'll tell you what the numbers are that I'm looking at. So this is the wheat USDA revisions that we saw on the last January report. And what we're looking at here is that domestic use was increased by 26 million bushels, and that flowed directly into a 26 million bushel decrease in the US ending stocks. So that was a friendly, kind of unexpected, friendly update on the report. This chart shows us the US wheat ending stocks that goes all the way back to the year of 1987. And you can see here, oops, I'm sorry. You can see that the green dot on the far right is where we're at right now. It's not a tight stock situation, but it's not the worst that we've seen either. So overall, we've got wheat sitting in a medium kind of a stock situation, and it's likely to get a little bit tighter because of some other world happenings that we'll discuss here in a few slides. This chart shows us or graph, I should say, this graph shows us the US winter wheat planted acreage, and this goes all the way back to 1984 as well. You can easily see that we're down the lower end of the planted acreage that we've seen in the past. We're up a little bit from where we were last year and the year before that, but still quite a bit lower than we have seen as far as winter wheat acres in the past. And then this graph just shows us the yield per bushel steadily increasing. If you look at a trend line, and production is lower on the lower end, even though yield is going up. This slide is interesting because it tells us what we are expecting for wheat acres for the coming year. And there's very, very big discrepancies between what the USDA is expecting for wheat acres versus what the private analysts are expecting for wheat acres. So these are USDA estimates here. So all wheat acres are looking like 46 million acres for all wheat. We know, or we think we know what the winter wheat acres are that have already been planted. So total winter wheat acres are listed at 31.991 million acres. So of that, we did see an increase in hard red winter wheat acres over last year, soft red winter wheat acres, and white winter wheat. So all three of those classes are showing a slight increase. So then when we look at spring wheat, they kind of categorize it all together. Spring wheat and durum wheat, when they're talking about expected numbers, they call it all other spring wheat. And so last year we saw 13.7 million acres total planted. And this year with their projected number of 46 total all wheat acres, subtract off the winter wheat acres, and we would be left with a expectation to see just over 14 million acres of all other spring wheat planted in 2021. So that would be an increase of 300,000 acres. Now thinking about your own farm, I don't know many people that are expecting to plant more wheat acres. I could be wrong and we could have a huge shift by the time we get into the field, but I think a lot of other people are looking at some of the other commodities that we enjoy growing wheat. I shouldn't say that we don't, we just don't like selling it all the time. So there's a lot of quality issues that can happen. But I think a lot of people are looking at maybe a few more soybean acres and or looking at growing corn if they are set up to do that. There's also some more expansion in canola acres as well, I feel, in the fringe areas. So whether we see an increase in wheat acres, that's yet to be seen, but that's what USDA is projecting. Informa is estimating spring wheat acres to be at 11.49 million acres. So that would be a significant decrease. So like I said, private analysts are on a different page than the USDA. This itself is interesting because you got to think about the winter wheat crop down south. Are we going to have a decent crop? I mean, you looked at the earlier US Drought Monitor, and it obviously looked like there was some definite problems in the winter wheat region. So the map on the left is showing conditions as of November 24th, 2020, so going into dormancy. And the one on the right is showing the US Drought Monitor as of January 19th. So just last week, you can see that the change between the two, there isn't a lot of changes in the major winter wheat growing areas. Minnesota obviously is getting drier, but then Texas actually. As far as the crop condition ratings going into dormancy, as a whole, the winter wheat crop was rated 50% good to excellent. And then in previous years, it was rated 52%, 55%. What this just goes to show is that, you know, a lot of times it doesn't matter where we go into dormancy. If it's right around that 50% area, give or take, 60% is always better. But if it's right around 50%, there's a lot that can happen with the winter wheat crop when we break dormancy. So the more important part is the rains that come in February and March, the moisture that they get as they break dormancy. So this crop could turn around. But as you can see by the drought monitor, there's a lot of work that needs to be done. There's a lot of moisture that needs to be replenished. And I'm not sure if you've been able to catch any of the weather webinars or anything like that that you sometimes can catch throughout the winter. But the weathermen that I've been listening to are predicting a continue dry pattern. So with some more concerns for the Red River Valley and potentially crawling into our area with some dry concerns. So, you know, again, that's just forecast, but it's not looking like these dry areas are going to go away. Another thing to consider is, you know, there's usually a lot of graze out on these wheat acres in the western parts of the plains if the crop isn't doing well. But because the prices are higher, we might not see a lot of abandonment. So it's just really going to depend on, you know, February and March when we break dormancy and start seeing if there's any rains that will be coming. So Russia is the kind of the wild card in the wheat market. They have a tendency to make small steps, but sometimes abrupt. And so, I would say right before Christmas, probably. I don't know, I kind of break my time period in my head around holidays sometimes. So before Christmas into December, we knew that Russia was having some issues with food prices, their wheat stocks and things like that. They at that time, trade was expecting them to come out and do some sort of an export ban or a restriction. And of course, the Russian government said, nope, nope, not going to do it. We're all doing fine. There's nothing that's going to be done now. And so the market, of course, went down again because it seems like wheat can be pushed down fairly easily and quickly. And but I said, just wait. Russia, they a lot of times will say that nothing's wrong, and then a week later or 2 weeks later, they'll come out and all of a sudden have issues. So we knew that there was issues that were going to go on, and it seems like the government just likes to make those announcements. So long story short, a few weeks ago, Russia came out, the government came out and said, okay, starting February 15th, we're not going to ban exports, but what we're going to do is we're going to put. So the export tax ended up being about 82 cents for the first round that's starting on February 15th. And then they came out on March, and then they came out again and said, okay, we need to tighten things up a little bit more. March 1st, that export tax is going to go from 82 cents to $1.56. So that's what we're looking at. So they're really, you know, the world buyers aren't going to buy because they're going to have this bigger export tax to pay. So truly what is happening is the farmers are receiving less money. So the government is trying to keep the price of food low in Russia, and it is essentially hurting the farmer. So not a very good pricing action for the farmers over there. But the European Union also has, you know, a decent sized crop, and they are a big producer in the world market. So you have to think that, well, a lot of this business is going to go over to the European Union. But really, they don't have enough supply to absorb the amount of demand that this will be bringing. So we are left to believe that the rest of the demand will come to North America, meaning the US and Canada. So right now, it looks like we are going to get a decent amount of that business, and that will help keep our wheat market supported. Another thing is think about the basis level. So if we have good exports, then our basis level should stay fairly stable. Usually around the March timeframe for wheat, we like to start to hope to see a 20 under to an even basis at our local elevators. And I'm not so sure that we're going to get to an even basis this year just because we simply have higher prices. So I'm not looking for that. But anything around 25 under at the local elevators, I think is going to be pretty acceptable for the year that we're in. So if you have a lot of wheat that is still in the bin, which everybody I know has a lot of wheat left in the bin. They might even have 2019 wheat in the bin. A lot of people do. So what I would do, we obviously know that we need to sell some of that grain. Buying more bins is probably, I mean, eventually you got to get rid of it. So we need to get it moving to the elevator. So if you get a 25 under, I would look at locking that and just start hauling. At this point, we would be having until February 20th to actually lock in the futures. I do think we're going to see more upside potential by that time. So right now I would lock the basis, haul it in, and then by February 20th, we can decide what we want to do. Do we want to sell it? Hopefully we get a good pricing opportunity by then that's acceptable and we can let some go. Otherwise, we can always re-own it on paper in a hedge account, or you can roll it at the elevator to the next contract month and give yourself more time. This I found pretty interesting is that the Russian FOB wheat offers about a week ago, they soared to $300 per metric ton. That doesn't mean that they're getting that, but those are where their offers went to. And that would be equivalent to $8.20 wheat in the United States. So that gives me hope that we're not done going higher. I myself do not believe that we're going to see $8 Minneapolis wheat futures. I hope I'm wrong, but I like to, how do they say it? Expect the worst, but hope for the best, and just keep your expectations low. I guess I kind of like to go at it that way. It's fun to be surprised. So just keep that in mind. So right now the USDA has the the Russian wheat crop pegged at, or excuse me, the Sovcon pegs the 2021 Russian wheat crop at 77.7 million metric ton. Last year it was at 85.9 million metric tons. So you can see that they're down from their production last year. Right now, USDA is expecting wheat exports to come in at 985 million bushels. So exports are something that we watch very, very closely a couple times a week. Inspections, that report comes out on Monday, and that is what is actually shipped out of the US ports. That's inspected, it's leaving the US ports. So far, as of this last Monday, we have shipped out 591 million bushels of wheat. And that's up down 1% from last year. but it's not a bad place to be where we're at right now, because we need to average about 18 million bushels per week in order to maintain this current export projection. And last year, from this point forward to the end of last year's marketing year, we actually shipped out 17.3 million bushels. So it's easily attainable. If we see a pickup in demand from Russia, we would expect to see that overall average go up, and the need for the USDA to increase the export projection, which would in turn tighten our stocks and give us higher prices. So sales, that report is generally out on Thursday mornings, and the sales are just that. They're sales. They can be canceled, but we like to, we do trade these numbers. We don't expect them to be canceled. Towards the end of the marketing year, there's always some sort of shifts that go on between old crop and new crop and such. But generally, this is what we trade. So 786 million bushels in sales so far. It is up 6% from last year at this time. And we need to average 10 million bushels per week in sales in order to meet the current USDA projection. Last year, we actually sold 12.9 million bushels from this point forward to the end of the marketing year for last year's marketing year. So it's very easily done, easily attainable. This is a weekly chart. When we look at charts, usually we look at daily charts, and we kind of move back and forth between intraday charts and sometimes weekly charts. But really this year, we've been looking at weekly charts all the time. It seems that, is a good problem to have, because you have to go back down, back to the 2017 calendar year before we were in price levels that we're in now. So this is a weekly chart of the continuous nearby contract. So what we've got here is March Minneapolis wheat. Well, I should say Minneapolis wheat is down a little bit today, but yesterday morning Minneapolis wheat was trading at 637. Our next pricing target is at 665. December Minneapolis wheat is at 659. And well, here, I'll just show you where we are at for our wheat sales targets. So 665, then 715. And then for new crop, we haven't sold anything yet. 715 December is our first sales target. Any questions on wheat at all? We're going to move into soybeans. Okay, so for soybeans, this chart up here, this is came out last year, last January 2020, and it was the estimate of where we expected the stocks to use ratio to go, or to be at, I should say. So at that time, they were expecting about a little over a little under 12% for a stocks to use ratio. This is where we are at right now. The projection is that we will end up coming in somewhere between 2 to 3% on the stocks to use ratio. Very big tightening there, very important. That's why the markets are doing what they're doing. This chart is this map is showing you where the red is. That's where the main soybean growing areas are in South America. And this is the December 24th to January 24th % of normal precipitation. So wherever it's green to dark green, that's at or above normal precipitation for those regions. And wherever it is gray, brown, orange, what have you, that's where they're below the average precipitation for those areas. So you can see that there's two main growing regions that have significant shortfalls in their moisture. And that's where the biggest concerns have been. They did get some rain late December into January that's really helped some growing conditions in certain areas, but they're still below average. So the biggest concern is the fact that they got the crop in so late. So some parts of Brazil ended up having to replant 2 to 3 times on their soybean crop because it was so dry. So there was just not any moisture, so they kept having to replant. The planting delays doesn't just affect, that crop. It affects their exports. Usually they've got a steady line of beans at the export port ready in March. And so that's getting pushed back until the end of March right now. So that is good. That's very good for the US soybean prices. There are end users that offer soybean products in the United States that they aren't even offering products beyond March or April because they're not sure that they're going to have enough soybeans, because that demand is coming to the United States. It's a fight to gather the soybeans that are left. It's estimated that 85 of the beans that farmers raise are out of their hands. They're already at the commercial destinations. So there truly isn't that many. I mean, we all know we don't have, I mean, I say a lot of us don't have a lot of soybeans left in the bin. If your bins are full, I give you high fives all around for taking it out. That would be amazing, but I don't know anybody that has it, so hope I'm wrong. But what that means is that, you know, the harvest delays are definitely affecting so many different aspects, and it's affecting the corn crop that's going to get planted there as well. Because their corn crop, they want it, when they plant it, it's obviously after soybean harvest, but it works out perfectly for the pollination time period that they want it to pollinate in. It's not the hottest time of the year, but pushing it back an extra 2 to 3 weeks is going to make a huge effect if they even have enough moisture to, you know, have a good start to the crop. So they have started harvesting just a little bit in parts of moderate yield reduction from the 2020 yields that they saw. Usually at this time, we're about 15% harvested in certain areas of Brazil, and they're really, I mean, we're about 1% is what they're basically estimating it at. So very, very early in the harvest progress there. Interesting little fact there that 15 to 20% of the soybean belt in the Brazil area saw less than 50% of their normal rainfall over the past 30 days. So it's dry. It actually, before Christmas, we were looking at it being absolutely the driest year in Brazil ever on record. They didn't have records that went back that had drier years. And so it's very dry. Now they're looking at it as being the third driest year. So still significant. The USDA on their January report, you know, the USDA doesn't like to rock the boat too much, so they just left their production estimate unchanged at 133 metric ton. But the private Brazilian analysts are coming in closer to 127 million metric ton. So that is a significant decrease just there. The map that I put up on the right is a concern for southern Brazil. Paraná and Rio Grande do Sul is expecting to get, they actually upped it. It's 5 to 10 inches of rain over the next 5 to 8 days, I think, or something like that. I can't remember the exact details, but that is going to be a huge concern that they're rust, the disease concerns that they're seeing there. And then also for the safrinha corn seeding, it's also an issue. And those two states account for 30% of the Brazilian soybean acres. So quite a bit, very important. In Argentina, oh, I should back up too. So I've got port strikes listed here on the Argentina thing because that always happens, always something in the news. But Brazil started, the truckers are striking starting February 1st. And I mean, it's always an issue, you always hear it, but they usually get resolved. So that's just something to keep an eye out for. The Argentine soybeans are still in the reproductive stage. So any kind of moisture that they're going to be receiving is still going to be able to help to some degree. USDA did actually decrease their production estimates for the Argentine crop by 2 million metric ton down to 48 million metric ton. Possible to see additional declines. It just depends on how much rain they receive in the next month or so. So this is the synopsis, I guess, of what we're really looking at. The big thing for the soybean market is they did decrease the 2020 yield by 0.5 bushel per acre, which ended up reducing our 2020 production by 35 million bushels. There was, in the end, there was a increase to imports of US soybeans coming in, or soybeans coming in, I should say. So the ending result was a negative 14 million bushels for supply. And then exports, of course, were increased by 30 million bushels. And so the ending stocks number, in a nutshell, was reduced by 35 million bushels down to 140. A lot of private analysts were expecting that number to get a lot tighter, you know, maybe 115, 125 million bushels, just because of the simple sheer volume of exports that we've been able to see lately. But USDA, again, likes to make small gradual changes. So this is what we're trading right now. I would anticipate that we'll be trading a lot tighter stocks with future reports to come. Here's a stocks to use ratio chart that that USDA is estimating. They're looking for the stocks to use ratio to stay right around 5 to 6% as we go into 2021, which it could get a lot tighter if we don't see the acres that they're expecting it to be 89 million acres. Informa estimates coming in closer to 90.1. And all the other private analyst estimates that I've been reading are right around 90 million bushels. So I'm not sure why USDA is low on that end of it. I was trying to figure out a good way to show you guys the ending stocks numbers and highs and lows and compare them to previous years when we've been in these type of stocks. And this is what I came up with. So that's pretty interesting, isn't it? The first thing I want you to look at is the red line. So the red line is the 2018 crop year. The stocks to use ratio is 22.9% or was 22.9%. The carryout or the ending stocks was 909 million bushels. So it was very large. And the average closing price for that crop year was 893. The high was 953 and the low was 802. So less than a $2 trading range for that crop year. So then you got to go back and look and say, well, when stocks were tighter, what were the highs? What were the lows? What was the average? You know, just to get a good gauge. Do we need to go higher? Should we start making prices? You know, we don't want to miss the boat, that's for sure on this. So going back to 2013, the ending stocks, or excuse me, the stocks to use ratio was 2.6%. So really close to where private analysts are projecting it to be right now. The carryout came in, the final numbers came in at 92 million bushels. Truly project that that's where we will end up, is a 90 million bushel carryout. They will not take it below that because we're already at pipeline supplies. They just have to keep making little incremental changes because they can't project a negative number. There's just, you know, mathematically impossible on that end of it. So the highs came in, they were looking at the stocks, looking at the projection, and the highs came in the previous year. There were still high prices during the actual 2013 calendar year, but the highs were set for that crop year back in the 2012 calendar year. The average price was $14.62, the high was $17.68, and the low was $11.58. And if you would have asked me about a month and a half ago, 2 months ago, well, maybe a little bit longer ago, do you think that we're going to see beans in the teens? And my answer was no, because we didn't see the weather problems developing in South America as bad as they are. And the stocks just kept getting tighter and tighter and tighter because we keep selling. China has an insatiable appetite right now for soybeans. They're also corn purchasers as well. So looking back, no, I didn't think that we were going to be beans in the teens. Obviously, we're here, which is a good thing. It's nice to have that. Nice to have that for sure. Do I think that we're going to hit $17 on old crop? I kind of do. I think it's very possible because of the simple fact that we just don't have the beans available. There has to be, the reaction of prices is rationing demand. It's a supply and demand thing. It's basic economics. You don't have the supply, prices have to go higher. I do expect prices to go higher yet. But when we're in big markets, we get big swings, we get weak stomachs, we get very scared. And that's just the way life is. And it's not going to change this year. So unless the fundamentals change and unless we see some kind of huge political change where all of a sudden China just starts rejecting, you know, returning the soybean sales that they've already made the purchases for, which they truly, well, I shouldn't say they truly can't. The information that we're getting out of China is that their stocks are tight and they need it. Their hog herd is growing. If they're not actually importing the pork from the United States, we either feed them here for them and ship the pork over, or they feed them over there. That's mostly what is happening. So granted, our information out of China isn't always the best, but looking at it realistically, I think this is truly the case. They need to have the product. So I do think we're going to see higher prices. So the biggest thing is going to be, you know, not trying to get extra cute on anything. If when we're making cash sales, you know, don't hold out for the last 10, 20 cents. That isn't what's going to make you rich, because as soon as the market flips, it's going to be harsh, because that's usually what it does. Oh, I guess I forgot to do my little circling here. Okay, so for 2020, looking at the current stock situation that we're in versus what we were in back in 2013, very similar. It's not showing to be quite as tight, but I think USDA just hasn't gotten there yet. I think they're just trying to paint a little bit better picture, and that's why the pricing is happening the way it is, because the private analysts and the market participants expect it to go to that level, and that's why we're seeing prices go higher. And another thing that happened on Friday, with the market going down as hard as it was, looking back, it was a good buying opportunity. And we were actually looking for something like that to happen, because once it becomes a situation where every person in the US realizes, a good trade idea is just to buy beans. Can't lose money, let's just buy beans, let's just jump in. As soon as it gets to be like that, then the market really needs to get shaken up a little bit so that the weak positions get scared, run for the door. And that was a perfect opportunity for commercials to come in and buy. China was again in buying over the weekend into Monday. So it just worked out pretty much textbook in that regard. So we talk a lot about soybean exports. Where really are we at? So that right now the USDA is projecting 2.230 billion bushels in exports. Right now we have, as of Monday, shipped 1.664 billion bushels from US ports. So we are up 79% from last year, which isn't a surprise because we all know what kind of pricing we had last year at this time and the situation we were in. So not a surprise to see the prices are higher, and we've shipped quite a bit more. We do need to average about 16 million bushels per week in order to meet the current USDA projection. Again, we are in such a different situation than we were last year. And last year, from this point forward to the end of that marketing year, we actually shipped out 21.9 million bushels. So 16 million bushels is extremely attainable. On Monday, the report came out with a 73 million bushel export inspection. So if we continue to have those big numbers, I mean, it's just, you don't have to be a rocket scientist to know that USDA is going to have to increase their exports. And they also updated they misreported the previous week. So they upped that previous week by 8 million bushels. So the net change to the spreadsheet, I guess, was 81 million bushels in just 1 week. So it's an awesome week. As far as sales are concerned, we've sold 96% of the total expected sales. So we have to sell 4.4 million bushels per week in order to meet the current USDA projection. That is a tiny number. Granted, we all know that, usually by the time February rolls around and into March, our export sales diminish considerably, and we do have small numbers going forward. That's being pushed back. Remember, I said that the harvest is getting pushed back 3 weeks. Well, here, this is getting pushed back. So we should expect to see really strong export sales into March. So that's something that we need to keep an eye on also. This is the weekly soybean chart, and it is a continuous chart. So we're looking at the nearby continuously all the way back to 2005. You can see that the current prices are right around 1360, I think is where I have them, from a couple days ago. November was around 1140. So the whole nutshell of this is that we have to ask ourselves every day and several times during the day is, where do we think the prices are going to get to? Are we going to be happy when those prices come? Not to say that you have to have a lot of open orders placed, but you have to be realistic also. Don't constantly want 20 more cents because it's going to cost you $1. Promise. It's happened many times. So a couple little quotes that I had come across, or little rules that I had come across in my readings over the last couple days, are good little reminders. It says a bear market will give up in 1 month what a bull market took to achieve in 3 months. So we've gone up. It's been amazing. Very, very fun to trade. But we'll come down twice as hard, if not 3 times as hard. So just keep that in mind. Major trends are seldom broke unless the market goes against the trend for more than 3 consecutive days. That's just something that we as traders watch, especially for making cash marketing sales. So it becomes, you get 1 big day down. Well, do we sell? Well, it's not 3 days. It's not like we've broken the trend. But 3 days later, if we're going to be coming down 3 times as fast as what we went up, ouch. So we are going to have to make sales as we go forward. Looking at your past 2020 sales, oh, I see guys beat themselves up. Gosh, I just got $9 and then I got a $10 sale, and oh Lord, look what I could have right now. You can't look back and beat yourself up, because if you do that and do that for the 2020 year, you're not going to make your sales that you need to for 2021. I'm not saying that I think that this market is going to go into a downward spiral, but the swings are going to be big. We're in a big market. We're going to see a lot of volatility. So pricing targets right now, old crop, officially we're 85% sold, and new crop, we're looking at the target of 1260 November futures to make that sale. Another thing to point out is that the new crop basis levels are also very attractive. So if you know that there's a certain amount of bushels that you want hauled in at harvest time off the field, go ahead and make those, lock in the basis for those bushels. Most places around here are at about 60 under for harvest delivery. Could get better, could get worse. Okay, so for corn, some of the numbers that we were looking at on the past monthly report were that feed and residual use was increased by 76 million bushels for the 2019 crop. They miscalculated some numbers, I guess, there. So the ending stocks decreased 76 million bushels for the 2019 crop, which flowed into a decrease in the beginning stocks for the 2020 crop, which is what we're trading right now. So that helped to tighten the ending stocks there. And then the yield ended up being decreased by 3.8 bushels per acre, down to 172 bushels per acre. So that was another positive for the balance sheet. It took away 400 million bushels total from our supply. Exports were also decreased by 100 million bushels, but that will likely have to be changed on future reports. And the ending stocks were down 150 million bushels. So corn in itself is not sitting in a tight stock situation at this very moment. It is projected to get tighter though because of the exports that we're seeing. So this is the estimate that we saw about a year ago for the stocks to use ratio. So just kind of in the middle from the trading range or the ranges that we usually see. And then if you look at the current estimate, it's down. So we're under 10 right now on the ending, on the stocks to use ratio. And that's much tighter than we've been in the past. Again, it's not in a super tight stock situation like we saw back in 2012. I do, however, believe that we're going to be getting closer to that level. Okay, for exports, currently USDA is projecting a little over 2.5 billion bushel export projection. We have shipped 737 million bushels from US ports so far. We need to average 52 million bushels per week in order to meet that current projection. Last year, from this point forward, we shipped almost 40 million bushels. So we've got a lot of work left to do, but I think it's definitely something that we're going to be able to reach and maybe even surpass. Export sales right now are at 1.843 billion bushels, which is up considerably from last year at this time. About 21 million bushels from this point forward in order to meet the current USDA projection. And last year, from this point forward, we actually sold almost 30 million bushels. So again, I think it's very easily attainable, and I do expect the ending stocks to continue to tighten. As far as what we're looking at for, this is what USDA is expecting, 90 million acres of corn. Informa and other private analysts have a much different outlook as far as their acreage, like we previously discussed. So corn acres from Informa, they're expecting around 94 million, which would be an increase of about 11 million, almost 11.5 million acres from last year. Wheat acres, like we mentioned before, expected to be down 200,000 from last year, and soybean acres would be up 7 million. So they're anticipating quite a few more acres being planted actually from last year. And, you know, the high prices, fence row, it's just the way it is, supply and demand. So there you go. As far as what the chart looks like, we've got some pricing targets or some resistance levels on this weekly chart as well. It does look like if we continue to see tightening of stocks and increased demand, that we should see continued rising prices. And I'm excited to see what the battle for acres will come to in the next month or two as people really try to pin down their planting intentions. One thing to note, you know, up here, we obviously can easily plant extra soybean acres. That's not a difficult thing for us to do. But in the big I states where where corn is king, they're looking at doing extra corn acres and less soybean acres because of their revenues. It just makes more mathematical sense for them to do that. So that would be a very, we up here seem to think, oh, everybody's going to plant more soybean acres, but it's not that way. It's in the fringe areas, yes, but there will be more corn acres throughout the middle of the Midwest, we project, and there will be, I would expect, in the northern areas or fringe areas, I should say, if people have the ability to raise corn, I think that there's going to be more corn going in. So for 2020 corn, right now we're about 60% sold, and we've got some targets listed there. 2021, we haven't sold anything. We probably will start to make some sales though as we get a little bit closer and start seeing a little bit more of a battle for acres. I would anticipate the ability to price will be there. So just a few things that we look at when we're devising a individual marketing plan for your farming operation, if you were looking for individualized help, is that we look at what your multi-peril crop insurance policies actually are, what levels are you taking, what are your APHs, things like that, to make sure that we're helping to tie things together. We also look at your storage constraints and your cash flow needs, because Lord knows we all have bills to pay, even though we wish we didn't. So we look at all those things and try to help make things as smooth as we can, all of your planning needs. We primarily focus on cash market recommendations. We do a lot of different things in hedge accounts and with spec recommendations and things like that. But our main focus is actually selling the grain at the elevator, because we all know it has to leave the farm at some point. So those are our main focuses. We do keep track of the basis levels on a daily basis. And most of the elevators that we deal with in Northwest Minnesota and even into North Dakota are what we track. So we've got a pretty good handle on seeing movements in the basis level, so we can make those recommendations also. And for those of you that aren't familiar with how we deliver our, a lot of it does come through cell phones. We do text updates throughout the day. There's an 8:30 update, a 10:30 update, a noon update, and a market close that a person would receive on your phone. We also like to put out a just a little brief, I guess, synopsis of what the markets are doing on that day, what's going on in the markets. You guys are busy, you don't have time to do all your own reading and things like that. So if we can give you just a quick little idea of why the market is doing what it's doing, seems like a person can kind of stay on top of things a little bit easier. And also our sales recommendations get texted to your phone as well. Crop insurance industry updates so that you don't miss any report deadlines, and also farm bill and FSA updates. It seems like the FSA office is hard to, programs I should say, is hard to keep on top of lately. There's so many things going on, different things you need to sign up for. You can't physically go in, so you have to hope and pray that your name actually got written down on that register when you called. I would, from my dealings, and I enjoy working with all of our local FSA offices, they're doing a wonderful job, but in my dealings, if you haven't heard back from them on a certain program that your name is supposed to be on the register for, please follow up. You are the only advocate for yourself. So if you don't get a payment, it's not their concern. They just figure that you didn't qualify for the program. So if you feel like you qualify, make sure your name gets on the register. If you haven't heard back from them, don't be afraid to call and check and see where your name is on the list. We also do a weekly market newsletter that's emailed out to all of our clients. It lists a good explanation of what the markets did in the previous week, what we're looking for them to do in the coming week, and then also our pricing recommendations. And then on the crop insurance side of things, we also do in-season growing map booklets. So you keep track of your planting dates. If you don't have a different type of system that you're currently using, these are very handy. You can also use it for your keeping track of your fertilizer records, your spraying records, and things like that. And then you also receive your map books for harvest to keep track of the load logs that Kyle talked about that you have to keep. So if you're interested in a full service marketing package, we have two different packages that are available, the silver service and the gold service. The gold service is really that service where, where we individualize it for your farm. We help you throughout. We make sure that the cash flow is coming the way that you need it to when your bills are due. Storage constraints are taken into consideration. It's just a really hands-on marketing approach with that package. And then otherwise, it's just the cash sales recommendations, like I said, that are primary focus. This screen is a trading disclaimer that I have to put up there. And that is about it that I had.